Hey everyone, welcome back to Veritas Aegis. Today we're diving into a topic that's crucial for anyone wanting to secure their financial future: growing your money. Whether you're saving for something big or just want to make your money work harder, this video is for you. Let's get started. Welcome to the foundational step of your financial journey. Before we can talk about building wealth, we need to get crystal clear on the fundamentals. So, let's break down the absolute basics of making your money work for you. The idea of growing your money might sound complex, maybe even a little intimidating, but at its core, it's simply about making a series of smart, intentional choices. Forget the old image of just stuffing cash into a piggy bank or under a mattress. In today's world, that's actually a losing strategy because of something called inflation, which slowly eats away at the value of your cash. True financial growth is an active process. It's about understanding the tools at your disposal and developing a plan that aligns with your personal goals, whether that's buying a home, retiring comfortably, or achieving financial independence. It's about shifting your mindset from being just a spender to becoming a strategic owner of your financial future. The two primary paths for this journey are saving and investing. They sound similar, and people often use them interchangeably, but they serve very different purposes. Think of saving as your financial foundation. It's the process of setting aside money in a safe, easily accessible place for short-term goals or emergencies. This could be a high-yield savings account at your bank. The main goal of saving is capital preservation, making sure the money is there when you need it. It's your financial safety net, designed to protect you from life's unexpected turns. The returns are typically low, often just enough to keep pace with or slightly trail inflation, but that's okay. Its job isn't to make you rich, its job is to provide security and stability. Investing, on the other hand, is your engine for growth. This is where you put your money into assets with the expectation that they will generate returns and increase in value over time. Unlike saving, investing involves taking on a calculated level of risk for the potential of a much higher reward. You're not just parking your money, you're putting it to work in the economy, buying a small piece of a company, lending money to a government, or purchasing property. This is how you build long-term wealth that outpaces inflation and truly grows your net worth. This brings us to a crucial concept: the relationship between risk and reward. In the financial world, these two are intrinsically linked. Generally, the higher the potential return on an investment, the higher the risk you must be willing to accept. Safe havens like government bonds or savings accounts offer low risk, but also very low returns. Conversely, assets like stocks in a new emerging company could potentially offer explosive returns, but they also carry a significant risk of losing your entire investment. Understanding your own personal risk tolerance is one of the most important first steps. Are you someone who can sleep soundly at night knowing your investments might fluctuate, or does the thought of a market dip make you anxious? There's no right or wrong answer. The key is to build a strategy that lets you participate in growth without taking on more risk than you're comfortable with. A well-diversified portfolio, which we'll discuss later, is the primary tool for managing this balance effectively. Now, there's one powerful force that supercharges this entire process, a concept Albert Einstein supposedly called the eighth wonder of the world. It's called compound interest. In simple terms, it's the interest you earn on your original money, plus the interest you earn on your accumulated interest. It's a snowball effect for your wealth. When you save or invest, your money earns a return. With compounding, that return is added to your principal, and the next time returns are calculated, it's on this new, larger amount. This creates a cycle of accelerating growth. It's a patient game, but the longer your money is allowed to compound, the more dramatic the results become. This is the secret ingredient that can turn small, consistent contributions into a substantial fortune over time, and we'll be diving much deeper into how you can harness its power in our next section. Now, how do you actually grow your money? It's a question that moves us from simply earning a living to building a secure financial future. The journey begins not with a risky gamble, but with a solid foundational step: saving. Before you can make your money work for you, you need to get a firm handle on it. This starts with creating a budget. Think of a budget not as a restriction, but as a roadmap. It's a tool for tracking your income and your expenses, giving you a crystal clear picture of where your money's going each month. A popular and effective method is the 50-30-20 rule. It's simple. 50% of your after-tax income goes toward essential needs like housing and groceries. 30% is allocated for wants, the things that make life enjoyable, like dining out or hobbies. The final crucial 20% is dedicated to savings and debt repayment. By automating this process, setting up automatic transfers to a separate savings account each payday, you make saving a consistent habit rather than an afterthought. Your first savings goal should be to build an emergency fund. This isn't investment money, it's your financial safety net. It's there to cover unexpected costs, a medical bill, a car repair, or a sudden job loss, without derailing your long-term goals or forcing you into debt. The standard recommendation is to save enough to cover 3 to 6 months of essential living expenses. Having this cushion provides invaluable peace of mind, allowing you to navigate life's surprises with confidence. Once your emergency fund is in place, you can shift your focus from just saving to actively growing your money. This is where investing comes in. While saving is about safely setting money aside for short-term goals and emergencies, investing is about putting your money to work to generate more money over the long term. The fundamental concept you'll encounter is the relationship between risk and reward. Generally, investments with the potential for higher returns, like stocks, also come with higher risk, meaning their value can fluctuate significantly. On the other hand, more stable investments like government bonds typically offer lower returns, but with much less volatility. Your job as an investor is to find the right balance for your personal situation, your time horizon, and your comfort level with risk. Let's explore the main asset classes. First, stocks. When you buy a stock, you're buying a small piece of ownership in a public company. If the company does well, the value of your share can increase, and you might receive dividends, which are portions of the company's profits. Stocks can offer high returns and have historically been a powerful engine for wealth creation, but they come with higher risk and are best suited for long-term goals, as their value can be volatile in the short term. Next are bonds. When you buy a bond, you are essentially lending money to a government or a corporation. In return, they promise to pay you periodic interest over a set term and return your principal amount at the end. Bonds are more stable and predictable than stocks, making them a cornerstone for conservative investors or for balancing out the risk in a more aggressive portfolio. However, this stability usually means they offer lower returns. What if you want the growth potential of stocks but are wary of putting all your eggs in one basket? That's where mutual funds and exchange-traded funds, or ETFs, come in. These investment vehicles pool money from many investors to purchase a diversified portfolio of stocks, bonds, or other assets. When you invest in a single share of a mutual fund, you instantly gain exposure to dozens or even hundreds of different securities. This built-in diversification is their key advantage, as it helps to spread out and reduce risk. Real estate is another popular option for growing wealth. This can involve buying a physical property to rent out, which can provide a steady stream of income and the potential for the property's value to appreciate over time. While it can be a powerful investment, it's also less liquid than stocks or bonds and requires significant capital and hands-on management. This brings us to the single most important principle for any new investor: diversification. The old saying holds true: don't put all your eggs in one basket. By spreading your money across different types of investments, a mix of stocks, bonds, and perhaps real estate or other alternatives, you reduce your overall risk. If one asset class performs poorly, another may perform well, helping to smooth out your returns and protect your portfolio from market shocks. Ultimately, growing your money is a journey of continuous learning. It requires you to define your goals, understand your options, and always weigh the inherent risk versus the potential reward of any investment. By starting with a strong foundation of saving and then thoughtfully building a diversified portfolio, you can turn your hard-earned money into a powerful tool for achieving your long-term financial aspirations. There are plenty of tools to help you grow your money. Apps like Insert Popular Apps make saving and investing easy. Books like The Intelligent Investor and websites like Investopedia are great for learning more. Taking a course can also boost your financial knowledge. Be careful not to let emotions drive your investment decisions. Avoid panic selling when markets dip. Watch out for fees that can eat into your returns, and don't forget about taxes. Most importantly, set clear financial goals so you know what you're working towards. And so, we've reached the end of our journey through the fundamentals of growing your wealth. Let's take a moment to recap the powerful concepts we've covered. We started by distinguishing between saving, which is about security and short-term goals, and investing, which is your engine for long-term growth. The cornerstone of this growth is the incredible power of compound interest, the process where your money starts earning money for you, creating a snowball effect that can build substantial wealth over time. Remember the rule of 72. It's a simple but effective tool to estimate how quickly your investments can double. We emphasize that before you can run, you must learn to walk. This means establishing a solid financial foundation with a robust saving system like the 50-30-20 rule and building an emergency fund that covers 3 to 6 months of living expenses. This isn't just a buffer, it's your financial peace of mind, allowing you to invest with confidence, knowing you're protected from life's unexpected turns. From there, we explored the world of investing, demystifying concepts like asset allocation and diversification. By spreading your investments across different asset classes like stocks for growth, bonds for stability, and ETFs for instant diversification, you can manage risk without sacrificing potential returns. We also highlighted the importance of avoiding common pitfalls, such as making emotional decisions based on market volatility, ignoring hidden fees, and trying to time the market. Your financial journey is a marathon, not a sprint. To wrap up, growing your money truly takes time, patience, and a commitment to making smart choices. The path to financial freedom isn't about finding a secret trick or a get-rich-quick scheme. It's about building positive habits. Start small, but start now. Stay consistent with your savings and investment plan, even when it feels slow. And most importantly, never stop learning. The financial world evolves, and your knowledge should too. The 30-day action plan we provided is your launchpad. Use it to turn this knowledge into tangible action. If you found this video helpful and are feeling more empowered to take control of your finances, please give it a like. It helps our channel reach more people who could benefit from this information. For more in-depth guides, strategy breakdowns, and financial insights, be sure to subscribe to Veritas Aegis and hit the notification bell so you never miss an update. Your engagement is what fuels this community. We genuinely want to hear from you, so please drop your questions, share your own financial goals, or suggest topics you want us to cover next in the comments below. Thank you for investing your time with us today. We look forward to seeing you in the next video.